Here's the thing. Most people think $10,000 is too small to matter. A practice round, a warm-up before the real money shows up. And Wall Street loves that mindset, because when you believe $10,000 doesn't matter, you stop asking how it actually grows. You stop noticing that not all dollars behave the same once they're invested. Look, $10,000 is not small. It's a lens. And depending on where you put it, it will either teach you how modern wealth actually compounds or quietly train you to accept underperformance as being responsible. This isn't an anti-Wall Street rant. It's about understanding why $10,000 invested in traditional assets grows fundamentally differently than $10,000 invested in companies whose real product isn't software or ads, it's data. Most people, without realizing it, put that money into systems designed for a world that no longer exists, a world of slow information and linear growth. Wall Street still prices assets like it's 1985. Data giants operate like it's 2050. The familiar path is to be responsible. You spread your $10,000 across broad market funds and established companies. You're diversified, you're patient, and historically this delivers average results. For every $100 you put in, you might expect $9 or $10 back year after year before inflation eats away at it. It feels safe because the narrative is familiar and everyone else is doing it. But traditional growth depends on time, not transformation. You're betting a company will keep doing what it's doing, just slightly better, for a very, very long time. That's growth that depends on time, not transformation. Now contrast that with data-driven giants. Their core advantage isn't a factory or a new piece of software. It's that they learn faster than everyone else. Every interaction creates data. Every data point improves the system. Every improvement attracts more users, which creates more data. You see it? That's not linear growth. That's a feedback loop. And feedback loops don't just compound capital, they compound intelligence. So when you invest $10,000 in a traditional asset, you're buying exposure to GDP growth. When you invest in a data-centric company, you're buying exposure to network effects and decision-making systems that get smarter over time. Let me put it this way. Traditional investing is like buying farmland and just hoping the weather cooperates. Data-driven investing is like owning the algorithm that controls the irrigation, predicts the weather, and improves the soil every single season. Same $10,000, completely different behavior. So why do we stick to the old model? Because our brains are wired to prefer predictability over potential. Wall Street markets its products as safe, not effective. They minimize your regret, not your opportunity cost. And opportunity cost is invisible. If your money grows to $18,000 instead of $30,000, nothing feels lost. There's no alert, no headline, just a quiet gap between what happened and what could have. Wall Street is built on those quiet gaps. Early on, a data-driven portfolio feels volatile, it feels emotional, and this is where most people get shaken out. But volatility isn't risk, it's the price of admission for non-linear growth. Here's the uncomfortable truth. Most investors don't underperform because they're stupid. They underperform because they're playing a game that no longer reflects where value is created in the world. $10,000 invested in Wall Street teaches patience. $10,000 invested in data-driven systems teaches how modern power actually scales. And once you see that difference, you can't unsee it. Your money is always learning something. It's either learning how to survive or learning how to adapt. Wall Street teaches survival. Data-driven investing teaches evolution. And the investors who win long-term aren't chasing excitement. They're quietly aligning themselves with the systems that get smarter with time.